welcome. Um, I think we have about 130 people, or at least I can see 101 signed on at the moment. Today is a good day in the markets, and it wasn't planned to only host this call on a good day, but I wanted to get my friend Rick Rieder to share some insights on the real economy with all of us. It turns out it's a important day as well in the markets with the announcements between US and China taking a cool off for the next 90 days on tariffs. But Rick, just for some background for our participants and for your benefit, what we have today is a good number of folks from the UC community. We've got some regents, we've got trustees of the 10 campuses, we have staff in my office, my team, we have members of the UC Office of the President, and of course, a variety of folks from our 10 campuses as well. So you've got a diverse group of constituents, everyone who cares deeply about, obviously, our pension, our endowment, our retirement savings, working capital, and you name it. So it's a timely call. And for everyone else's benefit, Rick Rieder and I and our fixed income team have known each other now for about 10 years. Certainly in my case, 10, 11 years. Rick manages close to $2.5 trillion for the BlackRock team, but all in fixed income. And some of you may have heard before the conversation started, I was trying to figure out other ways to describe Rick, but he'll start with a story of telling you how he was the commencement speaker in Emory today, because the actual commencement speaker didn't show up. So they asked him a couple of minutes before if he could step in. So if you can do that on the fly, then talking about the real economy is a breeze, right? But some of the other interesting things about Rick that he and I were just sharing is he is talking to Scott Besson, as he said, a couple of times every 2 or 3 days. So he can certainly give you a pulse on what is going on in the mind of Treasury, but also spends, I don't know if that's good or bad, a fair bit of time talking to Elon Musk. So you can ask him, we can ask him some interesting questions, and we can obviously dive into a variety of things. But with that backdrop, Rick, I know you've got some prepared slides as well, but let's just start off with, how today was an important day in sort of this journey of tariffs. How do you interpret today? Or maybe you missed the news because you were doing the commencement speech.
No.
But I'm sure your phone was, beeping green all the way through the speech, and it made you even feel more positive. But how do you feel about today and what got announced in the context of maybe the last 6 or 8 weeks of where we have been, which is sort of change? And I know your talk today is about taking stock as well.
Yeah. So thanks, Jagdeep. Thank y'all for having me. And yeah, I did get 4 hours notice. I'll be doing the commencement speech for the business school at Emory today. So I'm a little rattled from that. But and then I had meetings all day. So I told the group, I know they all they review their commencement speakers, and I said, please do that within the with the full scope of how much time I had to prepare. So they anyway, it was hopefully I think it went okay. But anyway, thank y'all for letting me do.
What was your key advice to the students?
Yeah, so I did. I went through. I have in my house these signs that say, literally in my office, that say "Work hard, play hard, give back, reboot." And I talked about. I just went on. Why I believe in all of them. And this idea. I talked about play hard being balance in your life, and I talked about play hard being, you do fun things with friends and family, and it creates balance. And then I'm a big, as you know, I have these schools in Newark and my programs in Atlanta. I'm a big believer in giving back. And I just talk about balancing your life and working hard, but then, making sure you create a full package of what you do. And so no, that was it. I don't know if it was moving or not, but that was my speech.
We'll take it to heart. Work hard, play hard. Give back, and reboot.
Yeah, that's
in
my
addition
life.
To stay calm and carry on.
Exactly. That is sort of my life. But listen, I thought, and I'm going to get into this. And by the way, I do these monthly calls. I'm doing one Thursday, and I pulled some pages from it, and so it's not to bore you with the entire description thereof. But listen, one of the pages that I'll show you in a second is on how impactful China is to the US ecosystem. And, with all the tariffs that the president has talked about, 145% tariff on China is not workable for the US economy. It's just not, US economy cannot withstand 145% tariffs. And in fact, I thought it was ironic. We think at above 30%, it puts significant pressure on the US economy. And it was interesting where they ended up. And I will say one thing about I watched President Trump's speech from 30 years ago, and I was blown away by the symmetry of the speech 30 years ago they did on Larry King with and in other venues relative to where he is today. He's very clear about he believes in structural tariffs, and he believes that there is and Mike Pence, who I've gotten to know through he saw me present on the debt in the country, and he calls me all the time. So then he came into my office on Thursday. And he said something I thought was interesting. He's the president believes that there should be a cost of doing business in the United States, and functionally that there should be a fence, in his words, a fence around the United States, and that there is a payment for entering what is the most powerful economic engine in the world. And so I think I think the president believes in it. And I would say there's one other thing um, that is super important. And I've had, in fact, next week again, I'm presenting to Congress for the third time in the last 2 months. And I presented to the House Budget Committee, and I'm presenting next week to a series of a big senatorial event. And one thing I've learned from Chairman of House Ways and Means and these budget committees is if you roll the $4.5 trillion tax cuts, and then you assume something like $1.5 trillion of budget cuts, which I am a devout believer in, we're not going to get it. We're not going to get $1.5 trillion over 10 years of budget cuts without putting too much pressure on Medicaid and and a series of others that I don't think we're ever going to be able to cut. But let's assume we get $1.5 trillion. So you get 4.5 of tax cuts, you get $1.5 trillion budget savings, you still have a $3 trillion hole. Well, if tariffs, for round numbers, if you have a 15% effective tariff rate, that actually works out to about 3 trillion over 10 years. 10% is about 2 trillion. So basically, the US needs the money. And we could debate who pays for it. Is it the country or is it the consumer? I tend to think it's more the consumer, but in theory, it closes the gap. And so that is the other structural reason why I think we're going to end up with an effective tax rate. Sorry, tariff. Well, it is a tax, but an effective tariff rate that'll be probably something closer to 15%. I think people have become energized with the UK agreement that 10% is where we're going to end up. And I really don't believe that. Um, China's obviously a big part of it, but I think you're going to end up with something like 15%. And give me a percent or two on either side of that, but I think it's closer to 15-ish%. But I thought today was a big deal because and I'll talk about some of this in the pages that I have. I've never seen companies pull back and sit on their hands as much as they are today, waiting for transparency around where we're going. And I thought today was, all it was is that they, like Jagdeep, like you said, it was a pause. But I think some of the commentary around it, and that I think that when the president say this is a reboot or something, maybe I'm stuck on reboot, but something, a restart, whatever he called it, for the U.S. China. I don't know. That was encouraging, but I still think we're going to end up with significant tariffs on China. So anyway, those are my initial comments, Jagdeep.
Fantastic. So let's put the last, I guess, since November of last year through now in context, because if we look at it just from the market's perspective, it looks like not much has happened if you look at it just from 2 points in time. But what has happened, you call it historic, and it's probably historic in many ways.
Yeah, no, I think it's there's so many ways to think about that or take that. I mean, I was with a good friend, a very large international investor this weekend, and he said to me, we international investors in the U.S. are going to have to manage their investments different. We're going to have to diversify more. And secondly, he said that the dollar as a hedge they're gonna have to hedge their dollar exposure more. And his comment was that more countries around the world are going to do that. And I think that's a big deal. And I think the world will be different. And I think that will be the case around how countries, I'll talk about the debt in a country and why I think it's such a big deal. But I think how countries think about US investments. I still think, and I'm going to talk about this, I still think, including US equities, there are not that many other alternatives. So while I think other countries will diversify more and hedge their currency more, the sheer scale of the US markets and the technology orientation of the US markets, the US equity market is so intense relative to anywhere else in the world that I think that is, I still think US will get a tremendous amount of financial investment. But yeah, I think it's a different world we're operating in. I will say one thing about it, not to go on a tangent. I'd say I have some sympathy for the idea that there's a social aspect around bringing manufacturing and jobs back to the U.S. I also think it's very hard over a period of, other than value add manufacturing, i.e. pharmaceuticals, where a number of pharmaceutical companies are moving production back here or to here, and or chip manufacturing, et cetera. I think other industries, apparel being probably the best example of it, I think are very hard to bring back to the US, and or it takes a number of years to do it. But I think there's a different, I talked to some CEOs, there's a different disposition around that I think is going to be with us for a while about how do you think about your supply chain, your logistics, your distribution channels. And I think that's to some extent disruptive, and we can debate longer term what the effects of that are.
Rick, did you want to use some of your slides?
Yeah, is that okay? Yeah, and
It is okay, and I wanted to just check in with you so that we can
Yeah.
put them on if that's helpful, and then
Yeah. So if you can, and I'll flip through these pretty quickly, and then Jagdeep, open up to any direction you
Yeah.
would like to go in. Hold on. So, hey, Deb, can you just plug my charger? I need my charger to plug in.
can
Okay.
can our participants see the slide clearly?
Can you blow it up to the whole size of the
Yeah, let's blow it up then. I'm hopeful all of you can see the slides in good size, but we'll blow it up to the full size. Let's just assume it's blown
Okay.
up, Rick, and you can go.
Okay, so the first thing, and there's a series of statistics. I'm actually, because I can't even see it online. But this first
Oh.
one, the other ones you'll be able to see. But the first one I just show, and without going through all of them, the volatility and the extraordinary pressure on the markets, and the fact that if you took April off, you really wouldn't have noticed, because we're back to, in fact, now we're even above where we were. So pretty extraordinary. And I'll say one thing about, we've invested. I also run some very big equities, so I think I have a couple $100 billion in equities that I run, and the liquidity or illiquidity of the market has been unbelievable. So I know I use the stat that the average S&P price, the amount you could trade at a point, is about on average about $18 million. This last month or so, it averaged about $1.5 million, meaning the amount you could trade without moving the market is pretty amazing. And the uncertainty around illiquidity has been incredible, including today. If you go to the next page.
So before we go to the next page, Rick,
Sure.
You just raise a point. So if I'm hearing that correctly, liquidity is tight in the market.
Yeah.
Yeah, I felt this in 2022, and my gut is as well that we're seeing liquidity being very tight. And so liquidity would this be one of the themes, which is if you're liquid and you have liquidity, you're in a good place and position for opportunities.
Jagdeep, and so I was saying, right or wrong, and it didn't feel as good today. I mean, I'm running more cash in my portfolios than I ever in my debt and equity portfolios than I ever have. And I mean, listen, I think there's going to be more opportunities that come down the pike. I think there's more, particularly in some of the credit markets. I think you'll see a higher level of defaults. I'm not that worried about credit in general, but I think there'll be more opportunities that come alongside of it. I don't think we're done by any stretch around these tariff negotiations. I don't think we're done by any stretch around, the economic data. The first quarter data that we have had heretofore has been good. The economy was operating in a really good place. And I think things have changed. And I think, we'll see some data that'll be less and less buoyant over the coming months. So I like holding a lot personally. We're holding a lot of liquidity. I like holding a lot of liquidity today. And whenever you get markets like this, I mean, you're subject to 3% moves like you saw today. I mean, some of the stats in here are pretty remarkable about the number of days you're seeing these sort of moves. So yeah, I think liquidity is a really big deal. And I'll say one man's opinion. I think hedging risk, and I've learned earlier in my career, the best hedge is reduce, have less of what you own. And I think hedging this, treasuries aren't, certainly long end treasuries aren't a great hedge. Gold, till you watch, I mean, gold maybe is a pretty good hedge, but it's pretty hard. The dollar used to be a great hedge. The dollar is a very different paradigm than we used to. So anyway, to me, just liquidity is a good way to keep some powder and not, and mitigate the downside in some of these markets.
I don't know. I think we're having technical difficulties on getting your slides up the way we'd like him to. So just keep going.
Okay.
Is it okay with you if I email the
I'll check.
slides to?
Yeah, of course.
Okay,
No
so we'll
problem.
email the
Good.
slides to everybody after the call, but in the meantime,
Okay. And
yeah.
the next one's, I think these, well, I don't know about the next one, but they should be ultimately easier. If you go to the next page.
We are on the, okay. You may have to just tell the story by looking at your slide.
Okay. So yeah, this is not the easiest. So if you look at on the upper left, what I'm describing is that you're starting to see the impact of tariffs come through. And what this shows is container bookings from China are down by as much as 60%. And we think that, they obviously today will unleash some of that. But you're also starting to see, probably what the top middle shows, is you're starting to see price increases on goods originating in China starting to come through. And I'll talk about inflation in a second. The other thing that's on the upper right is if you actually take, I mean, part of what this is it raises revenues. And you are starting to see that. The line on top is the fact that revenues are starting to move up. So if that's part of the plan, that is manifesting itself. The charts on the bottom that I'll just describe is, I think there's a really changing the ecosystem today is very difficult because functionally the developed markets, the developed world has outsourced manufacturing production to China. And so what that green line that you can see on the top is China's industrial production, and then the other three lines are US, Europe, and Japan, meaning China's become the manufacturing engine of the world. Shifting that is disruptive, and by the way, I said I think there's a social aspect to do it. I think in some areas will take place, but the chart on the bottom right just shows the US-China trade balance in machinery, and which is pretty extraordinary. Engines, metal, etc. So the point being, this is a pretty game-changing event. If you go to the next page, these will start to be easier to see, but the one thing I will say about the U.S. economy is what I show on the upper left is the U.S. is the world's biggest importer, and if you look at the upper right, the U.S. is actually less reliant on trade for growth than the rest of the developed world, meaning US economy will end up, as long as we get to 15% effective-ish, 15% effective tariff rates, because the US is a service economy, the chart on the bottom shows that roughly 70 to 80% of the economy is services. The US economy has an ability to actually withstand stress around goods economy, particularly if that number gets to a reasonable number and corporate CEOs, CFOs can move on from that. So I know it's a big deal. So we think U.S. economy. I've said this for a couple of years. People underestimate the resilience of an economy that is based on certain services and has evolved to services. If you go to the next page, we'll talk a little bit about something that is quite different, though, than anything I've seen in a very long time, and that is that people are sitting on their hands. So what I show on the upper left is consumer confidence that's come down dramatically, CEO confidence, which is a pretty remarkable evolution over the last couple of months. Upper right is University of Michigan financial situation the next year. I mean, that line is incredible. And then economists in terms of prediction of US going into recession and GDP forecasts. And then I show on the bottom right, Las Vegas visitor volume. So anyway, point being is in the interim, economy is going to go through, and I've described this in the media a number of times. I think there's a significant divot that could last for a couple of months, but then I think ultimately U.S. economy is in reasonable shape. If you go to the next page, let's talk about inflation, and then I'll pivot and talk about the Fed. You know, if you take inflation, this is pre-tariff. Inflation is just too high, and so people have been predicting the Fed. I mean, if you go back 2 weeks ago, the markets had the Fed at cutting rates. I think it was 6 times this year, and almost six or over 5 times this year at one point. But if you take where inflation is, if you look at the average percentile of all prices data, if you look at we're running core PCE, the 3-month moving average is 3.5%. Fed can't cut rates when you've got inflation running at 3.5% when you've got a 2% target. And the chart on the upper right is goods inflation. So the US has benefited from goods inflation coming down the last couple of years. Supply chain freeing up, obviously, disinflation around a number of different areas. But now what's happening is goods inflation is heading up. So the benefit to inflation has come off. And what I show on the bottom left is the UMich inflation expectations. And I really don't love surveys, but but boy, some of these surveys around inflation expectations have really spiked. And so the point I would make is I think going forward, and I'll finish talking about yield levels, et cetera. But I think the Fed's going to be here for a while, and I just don't think you can cut. Despite the president's urgence, I don't think you can cut rate of any significant magnitude. And if you go to the next page.
So Rick, does Jay Powell stay and complete his term? And assuming that's the case, but in 26 we will have a new Fed chair, and that may be Kevin Walsh, maybe Scott Bessent, somebody. Who do you think might be getting that job? And if they're going to take the job, I'm assuming they're going to make a lot of promises to the president to get into that seat, right?
So yeah, 100%. So I mean, the first thing I'll say is I think Jay Powell is going to make it through May 26th, which seemed to be in question. And I think there was a conversation with the president to the effect of you could fire Jay Powell, but you've got a committee of 19 and you can't fire the whole committee. And so it doesn't and I will say, getting to know Jay over the years, he's very much, I have huge respect for him. He's very much consensus oriented, and he very much takes the pulse of the whole committee. And so I'm not sure there would have been a lot of good in firing Jay. But I think he makes it through May of 26. I think Kevin Warsh, I think the president, I haven't talked to the president about this, but I think he's a fan of Kevin Warsh. I think Kevin Hassett is a very likely candidate as well, because I think he would adhere to a lower rate threshold. And so I think Kevin Hassett is very much in the running. And the one thing I will say that I think there's others that are, I don't think the race to who it will be is over. And so, but I think those two are the most likely candidates. But I know, I've heard things, I've been in conversations. I think there are others that would be considered, but I think those are the two most likely. And I think Kevin Hassett has a pretty good chance as well. But I think
How
those are the two.
about Rick Rieder?
No, I think that would not be. I think that would not be in the camp of without my wife divorcing me. And I think there is. I think I've asked other people about what their where they would be in that discussion as well.
Got it. So no, you don't expect any rate cuts this year?
No, I think so. I'm trying to think which slides I pulled because I didn't want to bore you all with too many slides. But I will say, and can I say one thing that I think pulled it in. I don't think I put it in here. So I think there's a really, really big deal, and I'm presenting this on Thursday. So 45% of the jobs in this country are healthcare and education. The last 3 years, 45% of the jobs, including and on Friday, the last payroll report, there were 177,000 jobs created, and 70,000 were healthcare and education. That is a big deal. And so the reason why I think that's such a big deal, I know from sitting on the board of Emory, we have 11 hospitals. These NIH cuts, these federal cuts to in healthcare, and I'm preaching to a group that knows more of this than I do. But that, I think healthcare and education are I think I know what we've done at Emory. I saw what Duke did. I saw what Stanford did. I know that there will be um, fewer hires in that space, and I know in terms of job freezing or salary freezes, et cetera. So I think healthcare and education is a big deal. And then the other one, so there's 45% of the jobs that have been in healthcare and education, and 21% have been in leisure and hospitality, restaurants, hotels, et cetera. And of that, and just to go through the numbers, so of that, we've hired 2 million people in the last 3 years through immigration. So that's 700,000 a year, roughly. So it's 60,000 a month, roughly. So if you think about that number, if immigration, which has come to a pretty close to zero, relative to where we were running. So if you take healthcare and education, leisure and hospitality, that's 2/3 of the jobs in the country. My sense is you'll start to see the payroll numbers come off over the next couple of months. And if so, I could see the Fed, whether it's July, it's certainly not, I don't think June is a possibility, but I could see July, maybe wait until September. Then I could see them trying to get a couple of cuts done. And what I'm talking about in a minute is I think the Fed has to cut rates because the debt problem in the country requires it. And I'll talk about that in a minute. But I think they need to see that data. I think they need to see that labor data deteriorate, Jagdeep, because I think otherwise I think it's hard for them to go.
Okay. Well, let's talk about the debt problem then.
Okay, so skip this next page. So this just this just shows the correlations and how different they are. Okay, if you go to the next page. So I'll just talk through some of these. So the one on the chart on the upper go back to page 8 if you would.
Assuming people can see the slides.
Yep, there you go. Sorry.
Okay.
So what that shows on the upper left, that's US Treasury holdings as a share of total reserves. So that line you can see, and that number is pretty staggering. US Treasury holdings as a share of total reserves, meaning international countries have been diversifying their holdings away from treasuries. The chart to the right of it is the value of central bank reserves in gold. And then what I show on the right, on the far right, is US Treasury holdings for China, being the yellow line, and the green line is China's holdings of gold. Point being is we've funded the debt of this country internationally. China used to own $1.3 trillion of our debt, $1.35 trillion of our debt. It's now down to 700 and something billion, and it's going lower. And most countries are going to fund their own domestic or hold more reserves in gold, euro, yen, and I think reserve currency status is becoming. I don't think the U.S. is being substituted for another country or another currency as reserve currency, but I think we're chipping away at reserve currency. And what in the table on the bottom, and I'll just talk through it. What it is gross financing needs for 2025, and it shows the U.S. at 38%. And the only country that's close to that is Japan. And Japan just puts it on their balance sheet, on the Bank of Japan's balance sheet, and yen went from 100 to 166 because they ballooned the balance sheet. If the Fed puts the debt back on their balance sheet, then you have a dollar issue, which gets at reserves. And the average term to maturity, and I'll show this in a second, of the debt, which is the second column, is too short. It's 5.8 years. Scott Bessent needs to term out the debt, and he needs to extend the term of the debt, but it takes years to do that. If you go to the next page, and I'll did I take that one out? I took it out. Anyway, I know if y'all are interested, I'll send you this whole monthly where I go through a bunch of this. Anyway, the net conclusion around the debt in the country is we're rolling over 573 billion a week. That is the equivalent of rolling Australia in terms of total debt every week in the United States. And we 6 weeks out of the year, we roll over 700 billion, which is the equivalent of rolling Mexico every single week. The number is crazy large at the same time that the international investors are diversifying away. Meaning we've got to get the spending down in this country. We've got to get, we could talk about, whatever happens to mandatory spend, which I don't think will be a lot. But I think the big tail risk of the system is what happens if we have long bond auctions that we can't roll over. Then you get pressure on not just pressure on the on treasuries on the back end of the curve, but it starts to pressure the question of reserve currency status and the dollar. And I go through this on Thursday. 2/3 of the world's transactions are in dollars. 2/3 of the liabilities are in dollars. It's a very dangerous paradigm for the global economy. But no, I think what Scott Bessent is doing, and I think what Congress, I think finally, I'm going to tell you from all these meetings, and Ray Dalio preceded me down there. I would say Ray, they listen to Ray more than myself. He's a bit more pessimistic than I am. But I think I think it's a big deal. And I think it's a really, really big deal. And I will say for the first time, I think congressional officials are sympathetic to that we need to address it. But this to me is a big deal for the whole economy and the financial ecosystem.
So Rick, I want to unpack this a little bit. Let's rewind the clock to before President 47 got elected.
Mm-hmm.
The things we're talking about, this level of spending, this level of debt, they were continuing to balloon. Obviously, the stock market was going up as well. It sounds like a lot of medication's been applied or strategies in the last sort of 6 to 8 weeks, but as I listen to you, it sounds like this stuff was needed, because if it wasn't applied, we would be on an unsustainable path. But we obviously don't like the medication as well. So in the real economy, I mean, how does this all translate into? I'm hearing you say this is important stuff that needs to get done. 15% in tariffs, right? Rate cuts. I mean, things of this nature. But yet every single day we don't like the headlines around these things and what it's doing to the volatility of the market. So how do we reconcile what is going on with what needs to happen and how we should sort of digest all of this?
So it's a tough question, and I would say a couple of things. One, and again, I don't mean to be political or take one side versus the other. I think hopefully the president, I mean, he's obviously an aggressive negotiator. I do hope that we end up in a place that, like I say, if I don't think China's going to say, you should take these treasuries back. That would be unpleasant. I think it's harder to fund ourselves, when there's concern about the dollar and there's concern about, that we're not dealing with the spending dynamics in the country. So I think that's a really big deal. And I think a lot of what the president ultimately and Scott Bessent are trying to do, I think ultimately are the right things. There is something today. So, I've learned in my career, there's 4 ways that sovereigns borrow. It's the government, it's corporate, it's household, and it's financial. And when we went through the European crises, it wasn't a government debt like in Ireland or Spain. It was a financial debt. But in the U.S. today, financials in good shape, is in very good shape. Corporate's in very good shape. And households actually, other than the low end of the income strata, which is definitely struggling. But in aggregate, household debt. So actually 3 to 4 are in really good place. The government has too much debt. The other thing that's happened, and some of it is there was this massive transfer of money from the public sector to the private sector post-COVID. And we can debate how much, or it clearly was the right thing. We debate, did it go too far? But the total net worth of the United States today is $218 trillion. 218 trillion is the net worth of the United States. So there's 36 trillion of debt. And actually, if you take net of the Fed, I think it's about 26 trillion net of the Fed. So let's say net of the Fed, there's 26 trillion of debt, and you have 218 trillion in net worth. We just got to get the money from the 218 trillion to pay down the 26 trillion. The hard thing is getting it there. I will say, I remember I worked with Mitt Romney on something that we're trying to get bipartisan agreement on bringing the debt down. And one of the ways to do it was a wealth tax. and that, the agreement was if you do on, the left agreeing with the right, if you did a wealth tax, if you did 2% across the board wealth tax, and because there's extraordinary embedded wealth in the country, real estate appreciation that's been passed down, equity appreciation. If you did a 2% wealth tax, then you can actually deal with the debt. I'm not a fan of wealth taxes, by the way, but let's say it happened, but if you did it, but then you can actually deal with it. The point being, we don't really like transferring the money from the 218 trillion, but we have to do, in some way we got to do it. And it's a question of how we do it. I don't think the president's going to do a wealth tax. It's interesting, this millionaires tax or what have you, but so, in the interim, I think there's some tough stuff. I mean, bringing down spending is difficult. But I think we have to do it, Jagdeep.
So how much of this slowing down, these executive orders and the crazy headlines is needed in order to get the congressional support to pass the tax bill? Is that the next big thing ahead of us?
Yes, sir. I think so I think part of why I'm presenting to the Senate next week is I think there's incredible consternation about where do we go, and including, I think, one of the senators asked me who was organizing it, said, the president thinks we could just cut taxes. We just keep, extend the tax cuts, keep spending, increase military, and then we don't have to pay for it. We got to pay for it. And so I think, part of what Scott's going to have to do, and I think some of the senior representatives in Congress are going to have to do, is come to some form of agreement on how we're going to get there. I find it, I get into a controversial subject, but some of the mandatory spend and retirement age and some of the Social Security, they seem to me, at least, and y'all probably know better than I, they seem untouchable at this point, which I think is fortunate. But I think there's going to be a big set of debate that I think will rage into the summer. And I know Secretary Peasant said that August. When did he say August was the date that we run out? But I think there's a lot of there's going to be a lot of discussion on how to get there.
Okay. I want to turn to universities for a moment. These cuts to science and funding in the NIH and what's going on to educational institutions. What's your perspective on it? And by the way, one of the questions that I was asked at the last board meeting was, Jagdeep, who do you know in the administration that can be helpful? And I quickly responded Scott Besson, but now I'm just going to say Rick Rieder.
No, Scott Besson.
If you have the ear of all of these folks, what do you think is going on, and how can you be helpful?
So, listen, I mean, I'll get in trouble. We have our Emory board meetings this week, and I'm close with the president of the university, and he made a comment. So at Emory, the Center for Disease Control sits on our campus, and we, it's where Ebola. We brought the Ebola patients, and vaccines were created. Listen, I think, and like I said, there's so many people on this call who are so much smarter about this than I. So I apologize for progressing in areas that y'all know better than I. But listen, I think these funding. I think funding for vaccine, funding for, healthcare, et cetera, I think is, university level, I think is going to be extremely difficult with these cuts. And I can't believe I didn't bring it. I'm such an idiot. But anyway, I'm going through it Thursday, or I'll send my whole deck tonight. But I go through the numbers, and the numbers are pretty staggering in terms of, wow, how is it here? There you go. Oh, it's just like magic. But anyway, what I put on this page, all I show in the upper left is that 86% of the spending is Social Security, Medicare, and defense, hard to cut. But then I show the annual funding, NIH funding, and estimated total federal funding for there's the University of California. There you go. On the right side, the numbers will have an impact, to say the least. And then one thing from this is earlier, the governor of New Jersey, I know pretty well, and he said, I have these chair the board of these charter schools in Newark. I've chaired 14 charter schools in Newark, and he said to me, if Medicaid comes down to the state level, he said, I got to cut per pupil funding, and if he cuts per pupil funding, I can't afford the teachers in my schools, and I would have 500 teachers or something. So I know but I think you get this trickle down effect through healthcare and into education. That I think is quite profound. And I think people underestimate, how big a deal this will be. And like I say, I mean, you can't get to the $1.5 trillion of spending cuts. I mean, you can't, without Medicaid. I mean, you go through the amount and others, you got like some 20 billions here and there. You can't get there. So anyway, all these things are linked together, and hugely important. And I'd like to say this is part of what I think when you start to see these layoffs and or lack of hiring, and this is what I think will allow the Fed to start to move. But anyway, it wouldn't be the way I would do it.
So how does a university or university leadership then engage on this conversation with the president and his senior advisors around sort of the difference between the reality of these cuts and the reality of their mission?
And again, I'm venturing the territory y'all probably know better than I. But I was saying, I've talked to the president of Emory today at their before graduation. He said an interesting thing. He said he's spending a load of time. And so it's an interesting thing. He said, these actually the staffers, at these for these Senate for these senators actually do all the work. And which I've had many conversations with staffers. I think he's right. And he said, I'm just spending a ton of time in DC and working with these staffers and trying to make the point. And I think that is the right way to do it. By the way, we went through today, which you all know, I mean, this endowment tax is, significant as well. I mean, the amount they hit, from this endowment tax that I think at this point is in the budget. That is also for university quite significant. So I don't know. I mean, other than that, I'm not. But like I say, I will say that the conversations now in Congress seem to be, at least they've taken on the subject because they've got to over the next 2 or 3 months.
So do interest rates then stay higher, even with a few cuts? And do you see sort of inflation structurally being higher for an extended period of time? And I know we're all long-term investors, but these next several quarters or year or two matter, right? Before you get to the midterm elections. And how do you paint a picture on inflation and interest rates?
So if I can, maybe I'll go back to one comment I made about the Fed to start as well, around why I think they have to get the interest rate down. And the average cost of the debt in the United States is 3.39%. And we've got an average maturity of 5.8 years. We rely, so of the 573 billion we roll a week, over 400 billion of that, I think it's 450 billion of that is in bills. And so what happens is we keep rolling off bills that were, remember during COVID, we were issuing bills at 0%, 1%. And now we're rolling off these bills and replacing with 4.5s, 4.25. So the cost of our debt is going to 3.75. There you go. There you go. So the bottom right is, yes, 482 billion bills a week out of the 573 billion. So we keep rolling off zeros, replacing them with 4.25, 4.5. So the cost of our debt is going to approach 4%. The only way you delever an economy is your nominal GDP has to be over the cost of the debt. So meaning if the cost of the debt is 4, you got to grow nominal GDP at over 4, which is almost untenable because the real potential growth in the economy at our demographic is about 1.5 to 2. So meaning you got to run inflation at over 2. Anyway, the point being the bar is high to delever. What does that mean? And what does that mean for the Fed? So part of why I think the Fed's got to get that rate down. We have to stop rolling bills at 4.25, 4.5. We have to get the funds rate down to 3 so that you can start to, and Secretary President has to term the debt out. So then what happens in the interim? Inflation, with tariffs is going to run a bit higher. I mean, core PCE is running 3.5%. You put another 30, 40 basis points on it for tariffs, that gets you to, gets it close to a 4%. Our economist projection for this year is 4% nominal GDP, 0% real, 4% inflation. That's not the ideal way to get there. But that's, it's part of why the Fed has a tricky challenge. How do you bring the rate down when that's facing it? But I think they have to get that rate down. It's just, the trade-offs are are challenging to say the least.
Well,
Hey, Jagdeep, can I say one thing
yeah, yeah, of course,
I
of
think
course.
I think inflation is going to be high for the next 6 months, 9 months. By the way, I also think there are elasticities in the substitution effect. So, maybe not as high as anticipated, but I am, and we'll go through them. There's some slides I do on the monthly. I think automation and robotics and productivity and AI particularly are going to change the world. And I think what's going to happen, and when you put tariffs on companies of this magnitude or on the system of this magnitude, and because it affects your cost structure, your logistics, your cost of labor indirectly, I think it will force AI, productivity, automation, robotics faster. And so I think we're going through, and there's a bunch of charts I have in this. I think the world's going to go through this, and particularly US, an extraordinary evolution of productivity that I actually think will bring inflation down considerably. But I don't think that's a 2025 event. But I think we're going to see this. You climb the mountain, there's a huge amount of infrastructure spent on data center, energy related to it, et cetera. And then on the back side of it, I think you're going to see some tangible derivative impacts on productivity.
So you're excited about AI and the prospects of what these new
Yeah.
technologies are going to do for the US economy?
I've never seen anything like it. Like I've never, we run a whole series of things around signal assimilation and we use portfolio construction and stress testing and scenario analysis, and we run a whole series of models through AI, and then all the things we do around that are human resource related or legal documentation. I think it's unbelievable. Like I think it's unbelievable. And part of this getting to know this this XAI stuff that Elon is building, and he is out there in where he thinks this is going. I mean, he's told some stories about a couple of years from now. I'll just say some things he said about, you'll be able to make anything you want for free. And this is his words. And you think about anything you want for free. So what's the value of money? And how do you think? Like, there's some crazy things that I believe, but I'm through some of the things we do in AI, and I'm sure the people on the call are way smarter than I about it. I think it's unbelievable. And I've never seen, I've never seen a technology. We've always shifted labor to a value add every time there's a new technology, but this technology, that is guided towards, making cognitive decisions is pretty extraordinary.
Rick, I am spending most of my time with our faculty at the various campuses, particularly Berkeley. And I have to say, I am more than jazzed in what I listen to. If they didn't know the world was going through what it was, they wouldn't even care
Yeah.
about the conversations we're having today, because there's a level of optimism and excitement about the prospects of what AI can do that hasn't been seen before. And so we're getting close to our sort of 2:30 mark here, and I really appreciate the time we've spent together. But let's just zone in on this a little bit, because the advice I keep getting is, well, the US is sort of going to blow up, and you need to take your money for the UC and put it into China and India and Europe and everywhere else. And I just keep saying this is the best place in the world to be. And I've said it for a long time. Now, you need to be diversified and take advantage of everything that's going elsewhere, because things are bi-directional as opposed to sort of this globally intricate web of things. But why are you excited? I mean, it sounds like you're also
Yeah,
excited about the prospects here in
totally.
the US. And
So,
maybe end with you talked about sort of nominal GDP, but the stock market is like in the US 192% in its value, 195% of the GDP of this country. People here are wondering stocks or bonds, right? How do you think about the stock market and the bond market as we wrap this call up?
first thing I will say, your point about technology. So I go through on this call I'm doing Thursday that I show if you actually took the structure of the S&P 500 today and you looked at it today, and we show it during different periods of time, and if you orient it towards higher ROE and technology, the multiple is not, it's, I still think it's a little high today given the move, but it's not nearly as scary because, like you say, there's such a high concentration of market cap in companies that throw off 35% ROE. Like that is pretty powerful. And then what I show is I show it relative to the rest of the world. China's got some pretty incredible technology, tougher to invest in, different, but boy, it's pretty hard to invest otherwise. So I don't know. It is the numbers are staggering, actually staggering. So what I did is I showed the market cap of different companies like Apple and Meta, et cetera, and I put it up against countries, and it's like staggering how big these are. So anyway, I'm super excited about it. Can I say one thing about this? I had the honor of sitting on Google's investment advisory committee, and their chief economist Hal Varians, many people know, he's a professor at Michigan. Anyway, he does this extraordinary analysis of the average work week, and it shows that the average work week 100 years ago was an agrarian economy was 100 hours, and it's now 34, and he thinks it's going to 15, and it's and by 2050 it's going to 15. I could see that, and talk about efficient economies and talk about big social assistance, but I can see where it plays out. Pretty remarkable. Anyway, what do you do with it with equities versus debt? Listen, I think with everything being said, if you said to me, I've got a 2-year holding period, equities are going to beat bonds. And I always talk about the long bond, like long treasuries yielding 4% and change. Like, I don't know, if companies throw off 18% ROE and you build book value at 18, you can compress a lot of multiple to beat the long bond at 4 when inflation is running at 3 and change. Like now in the near term at these multiples, and if you said to me, I talk a bunch on this call about income producing assets, like you can have fixed income today create a 7, and if you can create a 7 over the next year or so, I won't go through some of the slides on it, but if you go through a 7 without taking a lot of volatility, because you can stay in the front end of the curve, you can stay well into investment grade on average, like that's pretty good. And so my argument today is, if you said, investing for the next 6 months to a year, if I knew I could create a 7 at a low vol, I'd still hold my equities, but I wouldn't think about, whereas traditionally interest rates, I got on long bonds against my interest rate exposure, against my equity exposure, my beta or venture or private equity. Today, I think if you just clip coupon and you create, because of the funds rate staying here, and I think that's pretty attractive. But if you said to me over the next 2 years, 3 years, like equities are going to do their thing.
And we're long-term investors, and we have a horizon more than 2 to 3 years, but even
Totally.
2 to 3 year cycle. And, should we still think about equities at sort of 6 to 7% a year versus bonds at 4.5? Still looks like a better bet, right?
Yeah, and I think if like you say, longer term investor, I think equities are a lot better than 6 to 7, because I think the average ROE, and even if you haircut the ROE, I still think you build book at 12, 13, and so yeah, yeah. Like I say, in the end, per your comments and per what we were talking about, if growth is slower over the next year, 6 months to a year, would you balance it a bit more with income, because you can get income and until the Fed cuts rates, and the Fed cuts rates, and it's a different paradigm. But yeah, no, I'm enthusiastic about equities,
So
certainly over the longer term.
we have 4 minutes left. I have 3 questions for you, and they're all super easy. So first of all, you managed 2.4 trillion.
Yeah.
Red wine or white wine to stay sane every night?
Red.
Dark or milk chocolate?
Dark.
And who do you speak to or listen to the most in the midst of all this chaos, to try and make sane arguments yourself around what's going on?
Larry Fink. The I don't know, Larry. I'm a big fan. I know he's a friend of yours as well. He's pretty smart, and I also think Jamie Dimon is pretty thoughtful. They're both pretty bearish, think inflation's going higher, so I try and mitigate that a little bit. And then Jagdeep, I'm a groupie for I love tech, and I think we talk about Elon, but I love following the people like Bezos and Zuckerberg, and like I think they're Sam Altman's in there, and like I think those people are pretty legendary in terms of how they think about where we're going to be T+1 versus where we are today. So I tend to follow those people a lot.
Now, Rick, you taught me one thing years ago, which I
Oh
still
no.
do.
Oh no.
And this conversation today is about the real economy. And I remember when I met you, one of the first times you said to me, you read every day
Yeah.
the annual report of a company, a real company.
Yes, sir.
And I try to make it a habit as well. I mean, there's 500 companies in the S&P 500. Even if you picked up one annual report a day and read it, it gives you a much better perspective of what's going on
Totally.
in real companies and real businesses. And I picked that up from you
Oh, thank you.
years ago. You may not have realized that, but
Oh, thank you.
any
Yeah.
advice like that you want to give our hundred
So,
and some odd
yeah,
participants?
I think that it's funny that you say that because the irony around that is the markets feed off of surveys. And I think surveys, people like if you follow the ISMs or the human or any of these things, people they say what's on their mind based on like if you follow the S&P 500, they'll tell you what the surveys are saying. Like I think the industry relies on these surveys that are incredibly, people are in a bad mood most of the time, and then they spend like they spend what they can spend. But if you said to me, I get to read, I love reading annual because they tell you what companies are doing with inventory, what they're doing with capex, what they're doing with hiring. And so, now part of what the idea around AI is that we can assimilate that faster into our thought process. So I don't have to read everyone. The It's hugely helpful. I mean, it's just crazy helpful. And we're trying to do it now with downloading all this corporate data. And by the way, things like I think one thing I will say out there that the most important thing for the U.S. economy that I think people underestimate is the housing market. And so I tend to follow a lot today on what home builders are saying, what the financiers are saying, and so anyway, we've been doing an awful lot of thinking through that today.
Now you could put in an AI prompt and get a summary of the annual report as opposed to reading the whole thing on what the
It's a
company's
good.
doing. But look, we're at 2:30.
Yeah.
You may have to give another commencement speech that you're not aware
I'm
of.
done. I'm
I
done.
am very appreciative of our friendship and
Thank you, sir. I
the
appreciate that
fact
too.
that you jumped on. This is probably a good break from speaking to 500 students. We'll get you back again at one of these points. And for everyone that stayed on the call today, thank you so much. Hopefully you've gained some
Thank you.
interesting and new perspectives, and we'll hopefully do one of these again a month from now. Thank you all.
Thanks,
All
sir.
right, take care.
Thanks,
Cheers.
Jagdeep. Thank
Thanks.
you.
Bye.